All right. Good evening, everybody. Good evening, and welcome to the Wealth Mindset and Real Estate Investing virtual meetup. I am your host, Chris Price. Thank you very much for joining us this evening or on the recording if you're watching us after the live show. As I mentioned, my name is Chris Price. I'm the host of the Wealth Mindset and Real Estate Investing meetup. I'm also a managing partner at Boost Capital Group and the CEO and co-founder of Red Fox Multifamily. So let me give you a little bit about us before we jump into tonight's presentation. So first off, the Wealth Mindset and Real Estate Investing meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time, skill set, or network to do it at speed and scale. The meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing, as well as other proven ways to build wealth through real estate through passive investments. And this is sponsored by Red Fox Multifamily. Now, Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios and add passive income and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get access to from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands-on, allowing investors to add passive income, build equity, and save on taxes, all while being in an investment vehicle that's backed by a hard asset. And then finally, our last sponsor is Boost Capital Group. Boost Capital Group's vision is to become the premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. You can scan the QR code for my contact information, or you can simply shoot me an email at chris@boostmycapital.com. So thank you very much for that and look forward to hearing from you. So now let me get into the agenda for tonight. So first, we'll introduce the speaker, and then our speaker will give a presentation. And if time permits, we'll have some time for Q&A and virtual networking. Please do mute your lines when you're not speaking. Hold questions to the end of the presentation, unless, of course, our speaker invites you to ask questions live during the presentation. And then I'll also note this presentation is being recorded. So please note that if you do not wish to be recorded, you can drop from this meeting. And then finally, this material does not constitute an offer or a solicitation to purchase securities. This is information only and should not be construed as business, financial, or legal advice. And without further, let me go ahead and introduce our speaker for tonight. And I'm delighted to have Madhavi Jain here tonight to talk to us and educate us on how we can make our lazy money efficient with infinite banking. What I want to make sure that everyone knows, I've had a pleasure of knowing Madhavi for a little while now. That's been a part of one of her communities that I'll talk about in a moment, but it is really a pleasure to have someone of her prominence and her experience on this meetup to be able to help educate our community, and many of which I know watch on the recording that we post on YouTube. So I'm looking forward to everyone being able to tap in and learn. But Madhavi, for those of you who don't know, is the president, wealth strategist, and a podcast host at Think Outside the Stocks, which is now recognized as a top 3 podcast globally. Madhavi helps her clients with a twofold approach to grow, preserve, protect, and pass generational wealth. An efficient savings vehicle with infinite banking and risk managed investing in commercial real estate syndications. She is a passive investor coach and brings high quality investments to her clients via historically recession resistant assets classes such as multifamily, self-storage, industrial, senior assisted living, and more. Madhavi also co-founded Connected Capital Fund, a community-driven platform for capital raisers and fund managers with focus on due diligence to evaluate deals, collaborate, and scale together, solving and silo problems through. Prior to her real estate exploration, Madhavi spent 16 plus years in the IT industry, mostly with one of the top 5 consulting firms. And with her exit from the corporate world, she is now on a mission to change the financial trajectory of one family at a time and thousands more to come. So without further ado, let me welcome and please welcome Madhavi Jain. Thank you, Madhavi, for being here tonight.
Thank you, Chris. Thank you so much for that introduction. I'm excited to meet folks here, educate some, learn from them, and also answer their questions too. Thank you so much, everyone who joined in. I know it's a weekday evening, so you showing up, it means a lot here. So, Chris, I think Christopher, Chris.
Yeah, Chris is fine.
All right. So, Chris, you manifested something for me. You mentioned that my podcast is top three. I wish it could go to top three. It's a top 3%. So it makes a huge difference. But with that, I'm going to talk about a topic that I'm very passionate about. As Chris mentioned here, I wear a couple of hats, but one thing that I'm very passionate about is infinite banking simply because it's not shared enough, it's not known enough by people. So is it okay if I share my screen here?
Absolutely. Share away.
All right, so let's go and you start seeing my screen here and I'm in a presentation mode.
Yes, we can see it.
All right, perfect. Making your lazy savings more efficient, becoming a bank with infinite banking. That's what we are here to talk about today. Of course, Chris introduced me very well. Madhavi Jain, President, Wealth Strategist, and podcast host from Think Outside the Stocks. 2 cents from my lawyer. Chris already mentioned some few things for you to note. This is not a financial, legal, or tax advice. If you're trying to build this for yourself or invest into something else, please seek your legal, tax, and financial advice. I also want to mention that from time to time, I use a lot of numbers. I'm a very numbers person. I'm a math major. So examples here are just purely coming up from some scenarios. This is not your particular scenario. This is point in time, and a lot of market scenarios sometimes may impact as well. So please keep that in mind. So this is information and education purpose only. If you want to implement any of this, please perform your own due diligence. With that, let's get started. So just by show of count, now this I cannot see the screen, but maybe you can help me. But I always like to start by asking, have you implemented infinite banking? And if not, and most likely you're here because you haven't implemented it, the big question is why not? And when I ask this question to many of people that I meet through conferences, my investors, areas where I go in and do these webinars or co-host with people like Chris, I ask them, why haven't you implemented? And I get 4 answers. Typically, the bucket is number one, quite frequently, more frequently than ever, that I have never heard about it. So people do fall into that category. I have heard about it, but I don't understand it. I have heard, but I also heard that it takes time. So I don't think I want to implement it because it does take time. And finally, I've heard about it, I've learned about it, but I do not have enough time to implement. So I hear that, and if you fall in one of those buckets, and Tris, you can mention what bucket our audience falls in today, so I can go in depth in some areas and cater this for them. So yeah, and finally, one thing I do get that I think it's scam. It just does not sound like a legit strategy because people around me haven't heard about it, they haven't implemented it. So why should I, right? So I'm here to talk about all these areas, clarify because clarification, education is number one step to everything, right? But before we go ahead, we start talking about infinite banking, it's very important to know the person behind really think outside the stocks. Why is she talking about it? And where does she come from? This person is. I quite frequently say that I have an uncommonly common story. And I mean by that is that bits and pieces of my story, you're going to see that your story resonates with it. Somebody else's story resonates with. So I have that uncommonly common story. I came like many to this country with 2 suitcases and a couple of hundred converted dollars with my husband. So we built ourselves as a first generation immigrants. We built ourselves from scratch in this country. And it was a beautiful life, right? We had our first child here. We purchased our first house. We had a car. We were literally living an American dream. Both of us work on the same project, and we were one of the top 5 consulting. So this was more than we ever asked for, living an American dream, right? But then the life starts giving you some curveballs, right? For us, like many, commonly common story, 2008 was the first curveball. So in 2008, I was called with my husband because we worked in the same project in the office and said that on a Monday and mentioned that next Friday is going to be the last day on the project. And what it means in consulting terms that if you don't have a project in another 2 weeks, you're going to lose your job. So imagine we have a white elephant of a house in California. Both of us are on H1, have a child. We have this big mortgage that we have to pay in, and we don't have a job. Both of us are losing at the same time. What was even worse, that I was about to give birth to our second child. So with that, I went on a maternity leave. I gave birth to my second child. Just few days after that, my husband went on to paternity leave. But long story short, we had to start from scratch again in 2008. The market impact, the job impact, we rebuilt ourselves. We had to move from California to Austin here. We rebuilt ourselves, restarted. But in 2015, another reason, and this time it was my health reason, which I was struggling with a chronic illness. I had to leave my corporate, my top 5 6-figure earning job. It was a sudden exit. I know many of you start thinking about building a passive income and plan your financial freedom and then leave your W-2 job. But for me, it was like a cliff. I had to leave my job. And that's when I started my journey in real estate. And I'm actually very grateful that happened because, hey, when life gives you lemon, why stop at lemonade? Start making margarita out of it. And this is what you can see as a margarita of my life. So with that, I started dwelling into real estate, the traditional route, landlord, rental. Soon realized that there is a giant world of syndication and commercial real estate that's completely passive. And I was baffled by the fact that this existed somewhere and I didn't know about it. It really surprised me. And at the same time, I did find infinite banking strategy as well. So I realized that these two strategies separately had its own merit. By the way, infinite banking, I was super skeptical about it. I'm a very analytical person. So I was super skeptical about it. I went back to my spreadsheet, my numbers, and I proved to myself that I was wrong. And infinite banking actually stood grounds. So now I have these two strategies independently in the infinite banking and the multifamily syndication. Independently itself has strong merits, but working together, they were super, super powerful. So when I realized that, I was really happy. At the same time, it made me restless that the community that I come from, the tech community, the first generation immigrant, the pharmaceutical or medical people, they didn't even know about these strategies as if they were lived in a separate universe, which is parallelly running these strategies and these investments. And that's when I started Think Outside the Stocks, which is basically me implementing the strategy myself and starting to educate others as well with it. So with that, I started being a fund manager, a real estate fund manager, to bring vetted investment into my fund. And I started struggling with another problem that I wanted to do really thorough due diligence, and simply 10, 15 investments were coming to my table in a week. It was not humanly possible for me to do due diligence on this giant number of investments coming to the table. At the same time, I'm a very people's person. I love working with communities and as a family, literally. So I thought that somewhere on the other corner, there's some people who are struggling in silos doing this alone. So why not just bring it together, come all of us together, and Chris is a part of this community as well. But we came together and we started doing the due diligence. First of all, starting really best in class opportunities, do the due diligence together, and bring our investors on these really weighted investments together. So with that, 2023, I started Connected Capital. But whether it's Think Outside the Stocks or Connected Capital, my mission is, like Chris mentioned, that I'm on a mission. I'm on a mission to change financial trajectory of one family at a time, to make that 2-degree change now so their flight path could be completely different and thousands more to go. So with that, enough about me. Let's talk about you. I know why you are here. And most of you are here because you have big problems. Number one, you're constantly exchanging time with your money. Number two, you have increasing tax liability. More income you earn every year, more goes to Uncle Sam's pocket. You have fluctuating income. If you stop working, this income can go down. If you keep working harder, the bonuses, it's all fluctuating income. And the retirement or the passive income journey, it keeps like a moving target. It keeps moving away from you. So you think that these are your big problems. But guess what? If I tell you that this is just scratching the surface and there are bigger problems underneath this surface, you'll be surprised. But let's talk about those bigger problems before we start talking about what the solution is. My favorite quote by far is, we thought we had the answers, but it was the questions we have wrong. This is by Bono, and I really believe in it because if we live in a pond and we think like a frog, we look at the problems around us, we look at the solutions around us. But if we change our perspective and go from the eagle's eye perspective, suddenly we see the forest, the bigger problems, different problems, but we also see different solutions too. So it's really important to understand this problem. So let's start asking by right questions, understanding your blind spots. And that's really essential on our journey to understand the infinite banking. So let's talk about the financial blind spot number one. If I tell you your family is your number one blind spot, the blind spot, just like your car, when you're driving in your rearview mirror, you don't see that. That's your number one wealth destroyer. And I have a financial father's history to prove that. And so this presentation, you will see I bank a lot on numbers and also on the history. So the first historical element that I'm going to bring is in our financial fathers, the Rockefellers, the Vanderbilts, and Carnegies, right? So Vanderbilt, when he passed, he had about $200 million, $1.4 billion in today's net worth. His known heir, Anderson Cooper, a famous media personality, he inherited about $1.5 million. So still a lot of money. But those billions of dollars, where did the rest of the money go? Andrew Carnegie, tremendous respect, a lot of philanthropy. Most of it, what he earned, he gave away in philanthropy, building colleges, schools, libraries, etc. But he donated from where he created the wealth, not from the flow of it, right? But let's look at the Rockefeller family. Rockefeller family, John D. Rockefeller, when he passed about $9.6 billion in today's net worth, 150 plus heirs, $11 billion known net worth of the family, multi-millions to the charity year after year, but this family wealth is simply growing one after other. Why is it growing? The generation after generation, the year after year. It's not simply the dollars that they put in place, but it was tools and techniques. And that's the learning, lessons learned from them, that the tools and techniques is the most important aspect of what we will pass to our heirs. Your blind spot number two. Many of you do know that tax leakage is one of your biggest blind spot. And you're here, you're savvy investors. You have been with Chris. You have probably talked about our father, the rich dad of the country, Robert Kiyosaki quadrant, moving from self-employment, who pays the maximum tax, to employees, 30 to 40% tax bracket, business owners, because they now do the expenses first and then pay taxes, little bit less. But astonishingly, huge amount of investors are to the 0% tax bracket or moving towards that 0% tax bracket. So really trying to move from the left to the right of it. But really, when we talk about a tax destroyer, is it the money that you are paying to taxes? Is that the only leakage? It's only damage you have? Let's think about it. Let's take $50,000 that you earn every year with the 25% tax bracket, 15% tax bracket, and 0% tax bracket. If you put this money to compound 7% year after year, just for 10 years, not more than that, the leakage, the true impact of this leakage of the tax dollars, the difference between the 0% and 25% with that growth is about 200K growth. So that's what you're losing. Is you're not losing the tax dollars that you're losing today, but it's the growth of this perpetuity in future that you're losing on those tax dollars. So that's your number. If you want to save taxes, what's the first thing that come to your mind? Your qualified plan. So let's talk about the true impact of the qualified plan. Suppose you contribute 20,000 per year for 25 years, say about 500K. You will save significant amount of taxes. That's about, even at the 37% tax bracket, about $185,000. It's what you will save. But now let's talk about if you even triple that money in those 25 years, but even if you just triple that money, and now you're taking that money out, now somebody has to pay taxes. If you start taking that money out, and if you can successfully take that money out, even at the lowest tax bracket, 22%, you're going to pay about $330,000 in taxes, much more than what we actually save. But now, wait a minute. What if you pass this as a next generational wealth? What happens to that? First of all, let's talk about the tax liability in your retirement. This is the blind spot about the marginal tax rate, highest and lowest, how it has moved in this country. And this is simply a chart depending on who's the party leading our nation and what they believe in, and over the period of time, how the marginal tax bracket has changed. It has been stable since early 2000s, but really it keeps on changing. Not too long ago, the marginal tax bracket was about 70% the highest tax bracket. So during your retirement, even if you time your retirement, do you know what your tax liability is going to be? And now let's talk about, if you pass this to your heirs, next generation, how does that tax liability become for them? Because now with the Secure Act, the heirs have to distribute from it in within 5 years if they're kids. Your spouse has 10 years. Imagine now when you pass this wealth, say if you pass $1 million, in 5 years, 200K each year, on top of their current earning potential, which will be at highest at that point, they will be paying really the highest possible tax bracket during that time. So the money that you diligently save taxes on and put it into your retirement account, whether it's your retirement or whether you pass it to your heirs, is going to have a humongous tax bill. So now let's talk about the next blind spot, which is estate tax, looking at the exemption limit. Who here thinks that the estate tax does not apply to me, will never apply because it's a humongous. It's currently at $13.6 million per person. And with the one big beautiful bill, it's even going to be even better. Most of you think that it's not applicable to me. Again, let's take a look at the history of this nation. This is how the estate tax exemption limit has moved in this country. In 2001, it was merely 675K. Anything above that was 55% tax. Yes, we know that 15 million per person, that's about 30 million altogether, is what you can pass with the current one big beautiful bill. And it has also made it permanent. But really ask yourself, is that permanent? What can shift, what can change that limit? Because when it was supposed to sunset in 2026, if we have the Democratic Party, they were supposed to bring it back to its original levels, which is around 5 to 6 million per person. The political shift, that's number one change. The future Congress and administration can change that. And really, the budgetary consideration also impact a lot. With one big beautiful bill's impact, the 10-year decreased revenue for Fed tax is by about $212 billion. So really, ask yourself, where does the future stand? You can time your retirement, but can you time your death? By the way, the best time to die was 210 because it was repealed for just that 1 year for modified carryover basis to adjust that. None of us are dead and didn't die that time. For us, this is going to be our problem. So let's now talk about our problem at hand, which is your saving strategy. Let's talk about, how do you earn, save, and invest? You probably are earning through your W-2 businesses, rental income, the cash flow syndications. Probably your savings go towards debt management, retirement accounts, emergency funds. And when you're putting some savings away, you're considering bonds or high yield CDs, possibly the stock market portfolio and diversified real estate, right? We are going to talk about the emergency funds and the high yield CDs here. So we are not talking about investing and having high returns when we have the risk proportional to it. We are not talking about the stock portfolio. We're not talking about diversified real estate and other investment opportunities which has risk tied to it. We are talking about zero risk guaranteed growth. So we are talking something that you would typically put your emergency funds, your high yield CDs for, right? So that's the focus today. We are focusing on savings. These are the savings, which is the lazy money in your bank account. We are trying to make it more efficient. So that is the goal today, right? So before we go ahead, let's again ask the right questions about your savings. Now, when you think about your savings, how much do you think your savings is safe in the bank, in the lack of better terms, better institutions? You put it into the bank, in the FDIC insured bank accounts, right? So let me ask you that, do you understand the problem that your saving is facing today? How safe is that money? Is it losing its value or is it gaining its value? Let's talk about that. You must be really happy today that you're getting about 4% or more in money market account, right? But ask yourself a couple of years back, 2, 3 years back, when the Fed interest rates were the lowest, how much did we get in this bank account? Less than 1%, even 0.2 or 3% maybe, right? So that's number one problem, that this interest rate is fluctuating. The second problem is that whatever interest you have, whether it's 4%, 5%, you have about that 24% to 27 or 37%, whatever your top tier of the income tax level is, that's your tax liability. So effectively, if you even have 5% interest that you're getting, you're effectively getting about 3 to 3.5% considering your tax bracket. Now consider inflation on top of it, 3 to 5% inflation. Now that same dollar amount that you have been getting as an interest, applying taxes, applying inflation, is actually zero or net negative. So that's the problem. Even if you think that you're getting really good interest in an FDIC insured, it is really not serving you. And on top of it, when recession happens, where do you see that which institution really go belly up? From time to time, we have seen whether it's 2008 or SVB, the institutions go belly up. And even if it's FDIC insured, you just have to think about what really safety of the money that I have there, right? So that's the question number one, that is your savings serving you or really getting stagnant, right? The question to ask, that is your savings, is it applying the generational wealth depletion, the tax leakages, the low interest and the tax growth, insecure and volatile banks that it stays with, no or expensive asset protection? Think about that. If you get sued by somebody in this country, it's too common. Your bank account is one of the most liquid account and that they can have access to. There is no other expensive asset protection. We don't think about it. It can be FDIC insured, but it's not asset protected. And on top of it, the estate tax monster can be lurking on top of it. If you think about generational wealth and how you're passing it, right? And when you keep this money in your bank account, say you have 100K, 200K sitting in there, does the bank really offer you that any additional benefit, thinking that, hey, if you have your money in here, we're going to just provide you some kind of protection for your family if something happens to you, that we actually give them probably $1 million if something happens to you. So that's the question to ask, that do they provide you any additional support? And I'm going to explain that additional support in a minute here, right? So we think outside the stocks. Our approach, as we talked about, it's not about thinking like a frog in a pond, but really taking that eagle's eye perspective, going on changing, and not just thinking about making passive income, financial freedom, but it's about beyond passive income and beyond financial freedom to grow, preserve, protect, and pass your generational wealth. So that's what we are talking about today. And with that, I'd like to look at my investors or my own wealth as well in a Maslow's pyramid structure. In a pyramid structure, there is a foundation which needs to be a solid foundation, just like your house. Even if it burns down, the foundation stays. So you can rebuild from that. So the foundation where your emergency money is staying, where your protection for yourself is staying. So something happens to you or your finances, this money never ever goes away. This is guaranteed growth, is guaranteed there. It's a risk free. And now, because the foundation is strong, you start building what's called the risk capital. So you can start investing into different levels by taking moderate to high risk. As you go up this triangle, you have higher risk and lower control. So now you can start investing in yourself, in your business at tier two. Tier three could be your direct investments, whether it's rental real estates and something else. Tier four could be indirect investments, the commercial real estate, or somebody else who's managing those investments. And on the top sits the speculative, whether it's your VC, whether it's crypto, some high stake stock market investments. When I meet investors, this is typically the pyramid is upside down. And when you go back, think about putting a number in your own financial structure and see how your pyramid distribution is. Is it upside down? Is it too heavy in the center? Does it even have a foundation? So that's a question to ask. And when you look at the blueprint, like the top 1%, the wealthy of the America does, they also talk about four strong pillars, which is the life protection, the tax planning, not tax filing, tax planning, asset protection, as well as estate planning. So that essentially is how you can think about protecting, passing, and growing your generational wealth. And on top of it, when you do the estate planning and insurance, it putting that risk, that checks and balances in your financial pyramid and structure. So today, out of this pyramid, we're going to talk about just this foundational layer. We're not going to talk about anything else, but just the foundational layer. So let's talk about that tier one, which is creating your own bank. Now imagine a saving strategy, a bank, which is the infinite banking, as a black box. And think about the advantages that it can provide you. How about it can provide you guaranteed growth better than bank? And this is not fluctuating based on the interest rate, right? What if it can provide you tax free growth that you don't have to pay taxes on this growth and you can withdraw tax free using a leverage strategy? You can contribute to it without any limits, not like 401k or 529 plan that it has certain limit, or even your Roth IRA, which has certain limit, but you can contribute without limit. In fact, you can create your own limit to contribute to it. If this is available, if this is liquid to use for any purpose at any age, it provides you automatic asset protection in most states, and it can create income tax free generational wealth to pass to next year. So, unlike your 401k, this can pass to your next generation completely income tax free. For estate planning purpose, you can also build some structure, some strategies within this so that it can have exempt from your estate tax limit as well. And how about this is done with an institution which has been existing 150 plus years. They have never lost money, even during the Great Depression, even during the recessions and different challenges. And this have seen World Wars too, it has seen Civic War too. So this has been in sustenance for a long period of time, even before we were born. And what if I can tell you that this actually protects biggest asset, and that's you. And remember I was talking about when the banks have 100, 200k into the bank account, they do not provide any additional protection to your family if something happens to you, but this actually protects the biggest asset, that's you, if something happens to you. So now let's take the curtain away. Let's talk about what infinite banking is. Infinite banking is a strategically structured whole life product. This is not your IUL. This is whole life product with mutual companies which are paying dividend. Now, many of you, when you hear the word life insurance, get flippled away. Don't worry, I was like that too. But this is where I found when I did my analysis that this really stands a chance. This is really a robust tool. And going back to what I was mentioning right before, all these benefits do still apply to that. It's just a vehicle, it's just an engine that's used from the life insurance product to create something which works because now, because of the life insurance, it has an ability to generate a cash value. What we do is that when it generates that cash value, the insurance companies provide dividend on that cash value. So the strategy is to overfund it, which is not normally done in a whole life product, overfund it so that when the insurance companies give dividend, it gives dividend on the overfunded portion of it. And now you can actually enjoy and live your life insurance, because life insurance, when it has the word life in it, supposed to be just a death benefit, and you thought that it is a death benefit money that I will never see. But this can actually build something during your life that you can enjoy, you can build for different purposes, whether it's your retirement, whether it's purchasing real estate investments or a syndication, investing into it. It can be used for multiple purposes using that cash value. And it also, on top of it, protects your life. But wait a minute. It's a life insurance. I thought that I only need it through my liabilities, the years of liabilities where I have the education or the mortgages, etc. And then typically people just end up buying terms during that liability years, right? So I'm going to start talking about, remember, beginning we had a couple of those reasons why people don't implement it, right? So this is number one reason. And as I say that this is very important to learn that this is a strategically structured whole life product with mutual company paying dividends when it's overfunded. This is how we use this product to become your own bank, right? Mindset is really important beyond that financial freedom and passive income to grow, preserve, protect, and pass your generational wealth. So let's talk about changing that perspective is why life insurance. Now think about your potential, your income earning potential. I have an example here. I'm a very numbers person, like I said that. Age 40, who has an income 150K and has about 100K in the savings. Suppose this savings grows 6%, his income grows 3%, which is just adjusted to inflation. And every year, 6% of this income he's adding to the savings. And by the time that he will retire in 25 years, do you have any idea? Can you guess how much money can be put against this person? How much money, the income potential that this person has, and how much wealth potential with that growing that 100K that he has? I don't see the chat window here because I don't know if you see that, but the income earning potential. Do you want to make a guess, Chris, here?
I I don't have a guess off the top of my head, but there's nothing in the chat.
Okay, perfect. The same person with that 40 years of age, 150K starting at 40 and putting that money away on the savings, he has $5 million income earning potential and that wealth growing potential about 10 million plus. This is massive. I want you to understand that when have that earning potential, you have that subject matter expertise. As you grow older, your subject matter expertise increase, your income earning potential also increases. So you are actually the ghost that lays the golden egg, and we are behind protecting our golden eggs. Our car is insured, our home is insured, but you are forgetting to have a permanent insurance for the goose itself. So the term protection or the term, it cannot really protect your true potential. So I like to look at this visual. When you have the lifetime earning the potential, the flow of money, the way it works, that this is a big tank. You don't get all of that money at the same time. Every year, some money comes through this pipe. Your first leakage is the tax filter and the lifestyle, the standard of living that you maintain. And that is your second filter. But every now and then, we all try to push the money of this chute into two buckets. One is the savings bucket and one is the risk bucket. Now, on the right hand side, this is where your emergency fund is. This is where your saving, where your safety is. If something happens to you medically, something happens to your business, your rental properties, this is the money that you use to repair that broken AC or even going on a vacation or something, right? What's really important to have that tightly that no evaporation happens here. We saw that your savings are evaporating to taxes, to inflation, and even to that fluctuating interest rates, right? Because of this savings, now from time to time, you can take some risk and some evaporation do happen, including the tax filter here. But this is what you want to protect, right? So the insurance considered as a cost versus protection. Can you think about what insurance you have right now and what can you cancel? Can you cancel your home insurance after 20 years, 30 years, just like you are tending to cancel your term, thinking that, hey, after 30 years, my house will be completely paid off, so I don't need an insurance. Or after 30 years, I don't need an insurance on my car. You're going to have, even if it's an older car, you're going to have some kind of protection. So you cannot cancel those. So why would you cancel an insurance on which is you are your biggest asset, which is an appreciating asset and not a depreciating asset? So that is one food for thought. If nothing else is take away, just take away this fact from this presentation today that why would you not protect the golden goose that's producing these golden eggs and all the golden eggs that you have been trying to protect and preserve with those insurances? So let me repeat all the benefits that I had been talking about. This bucket, the strategically structured whole life product with mutual companies, when overfunded, earning dividends which are stable year after year, which is providing guaranteed growth. So there is, sorry, it's not plus, it's either guaranteed growth or the dividends. But the guaranteed growth is a contract written into it. And that's why I can confidently say that there is a guarantees built into this. In our investment world, Chris, we cannot quite often say that this is guaranteed. We always use the word projected or target IRRs or target annualized returns, right? But this has a guarantees built into it. And historically, these mutual companies also have a strong record for providing that consistent dividend. It provides you tax-free growth. Because the cash value grows inside, it's beyond that boundary, it is tax-free. So every year that tax does not come out of it, you can contribute without limit. You can create your own limit. You can create a limit where you can fund with $500 a month. And I have created for somebody who has been funding even 200K, 250K a year. So that is the kind of flexibility that you have. Of course, there are some restrictions, there's some checks and balances. If you want to get $10 million life insurance, you cannot just go and get it. Liquidity, you can literally use it for any purpose. You can use it for your kids' education. By the way, FAFSA does not consider this as your asset. This cash value, even if you have $1 million inside, it will not be reflected on FAFSA because it's not considered an asset. But if you want to have an accreditation letter, this is considered as your asset and it actually shows up. So it's very interesting how it doesn't show up when you don't want to, and it shows up as your asset when you want to show it. You can use it at any age. So if you say want to retire when you're 55 and start drawing this from this as a retirement income, you can do that. You don't have to wait for crossing that age limit to withdraw it. If your kids don't use it for education, you can use it for buying a vacation home or whatever. This is your money. Literally, you can do anything from it, what you want to do. It has automatic asset protection in most states. So if somebody sues you, this is again across that wall. They don't see it, so this money is protected. It also is passed as an income tax free generational wealth benefit to your heirs. And this is probably the first check that's going to come out worry free to your heirs. And if they want to take care of some things right after the death, this is going to be the first check that's going to come out. This, again, 150 plus years, never lost money even during the Great Depression. As I said, this protects your biggest asset. When you start with 100K or 50K or even 20K, we have that considerable amount of death benefit, and that death benefit could be 500K, it could be $1 million. I have done it for people who have started with $4 million, $5 million as well. So that is the protection. If something happens to you, that your life is protected, your family is protected with. But now, on top of everything, what if I told you the strongest benefit of it is using as an end asset? So when you have savings in your bank account and you have an investment come up, you take the savings out and you put it into investments. But in this case, because you can leverage from it, just like your home equity loan, this money grows compounded tax free with all these benefits till the day you die. It can compound that and create that snowball, and you can leverage from it and put it into your investment as well. So growing and investing can be done at a small cost of paying that simple interest to somebody else and as an asset. So really, when we look at that same structure some time back, when we built the safety net here, the savings account, now we have the high cash value life insurance here. The death benefit just sits on the top of it. But on top as well, when we have the benefit that's coming in compared to other assets in terms of liquidity, in terms of safety, in terms of the rate of return compared, and how is it taxed? This is the life insurance, permanent insurance policy, which also provides the protection as well as the growth for your banking, the savings account, right? So traditionally, when life insurance was just used for protection only, infinite banking strategy combines the life insurance and provides that savings and protection to you. So now going back to that same visual that we have, now suppose you have your savings, you have your emergency money here, you have property or business reserves here, and now you have opportunity dollars. So you have 50 to 100K and you want to buy a house, a rental property with this. What happens is that now for a rental property, for example, if you have 75% loan and 25% down payment coming from that bank account, which is typically your savings account, and you pay that down payment, in this case, you're going to borrow, you're going to take a leverage from somebody else, most likely the insurance company. Instead of emptying this account, which is inside the infinite banking system, is going to continue to grow tax free and compounded. And now you're 100% leverage, and you can take care of that leverage from the cash flow that you're taking care of, and as well as the appreciation when you exit this property that you have created. So that's why, my friend, that you borrow, you don't withdraw your money. and you have your money do the two jobs at the same time. Create once, use multiple times. This is how you create the infinite banking structure, which is making your savings more efficient. Once created, you can use it for multi-purposes at any age without any restriction or even penalties. So you could use it for investments. You have created a foundation, which is a risk-free foundation. You can use it for real estate investment, which I think is a risk managed investment, or you can even use it for crypto. It's really up to you, but you can take a risk from that opportunity dollar, not from the safety dollar, but from the opportunity dollar. You can use it for your education. There's no impact on FAFSA. You can use it for retirement. You can retire at any age. You can use again tax smart withdrawals that you can borrow up, you can withdraw up to the basis tax free. And when you reach that beyond that point where it's growth, you can switch to withdraw from withdraw to loan that's leverage and get that still tax free benefit. And what happens is if suppose you have a $2 million debt benefit and you have about say 600K outstanding loan that's leveraged that you have created, the heirs are going to get that 2 million minus that 500K outstanding loan, that's 1.5 million passed income tax free to the next generation. Other uses that you can use for is you can use for business. So whenever you have to use anything from your savings account, you are going to create your banking system, move everything that you have into this banking system because this is proven and this is liquid and this is accessible to you. And whenever you need to use, just like your bank, the big chunks of money, you're going to directly use it from here. There are some advanced strategies, which is volatility that you can use it with the stock market, which provides excellent hedge against stock market during your retirement years as well. So literally, as I can say that infinite banking system, you use the same dollar at two places as an and asset. You build that net cash value whenever you want have expenses, whether it's education, cars, vacation, you take the policy loan and you refund that back. And if you have investment, same thing. You build the cash flow and repurpose, keep on repurposing over and over again. So with that, the living your life insurance with infinite banking, which has never lost money in 150 plus years, provides you tax-free growth and distribution, guaranteed returns with proven dividends, easy access to emergency funds, no credit check, no approval, no cost to leverage from it, no limitation on contribution or access to any amount at any age for any purpose. You can use the leverage for that access, which is tax free as well, and pass on the tax free wealth to next generation, which is income tax free. For estate tax free, you can create some advanced strategy as well and provides you that automatic protection. And Chris, if we have time, I do want to talk about
Yes,
this.
we have.
So I do want to talk about and I often get this question that what is the consistency these insurance companies have provided? I pulled up some dividends. By the way, 3%, 2.5 to 3% is what the guarantees that are built in here. But if you look at the history of these dividends, and Penn Mutual is one of the companies that I really like because it creates a great infinite banking structure. The current dividend is at 6%. So even if with compared to the banks, they're at a higher percent here. But go back to the age where we were getting less than 1%, it's still a 5.75%. So they did go down from 6.1 to 5.75%. But you can see that's not a huge drop, even it's the lowest environment of interest with Fed's interest rates. This was providing 5.75%. Now let's go back and look at 2008, which is right around here. We know that the banks went bad, real estate crash, but look at that dividend, 6.3%. So really going back, when mutual lowest guaranteed is 3%. None of these years you can see the 3% because they've always provided dividend. So again, it's not the guarantees plus the dividend. The dividend takes care of and replaces the guarantees. So when you get the dividend, you just get the dividend, right? So going back to the Great Depression, the Civil War, the World War, those are the even the times that they have consistent dividend paying history for 150 plus years. Penn Mutual is actually 170 years old. So this is one thing I did wanted to bring in. So that's what I think outside the stocks. We believe in creating the foundation first and starting everything with the education. So understanding your goals and objective. Why do you want to implement this infinite banking? Do you intend to use it for education, for your retirement, or simply as a leverage for your real estate investments and as an and asset? So that's essentially what we are looking at, you're getting a threefold advantage, not just efficient savings, which provides you better growth than banks. We just looked at their dividend paying history, providing you tax free growth and uninterrupted compounding. It also provides you life protection, which is liabilities and beyond, which protects your biggest asset and pays 100% of the time. Life insurance is a benefit that you always get paid. And it also creates your generational wealth, which is income tax free, which can be utilized by paying estate taxes. And within it, which is an estate tax strategy, you can also make that estate tax free as well. People often ask me that where is the catch? So yeah, this is a based on a life insurance product. So it is based on medical qualifications. If you have a good health, being healthy is a plus. If you have some problems, it still can work out. But if somebody comes with some conditions that they are absolutely not insurable, then we look at their spouse or even kids. So we can create this structure, this strategy on your family members if that's the case. It does have a time capitalization factor. You must put in the money before you can start using it. It's not a get rich overnight scheme. But literally, when you push money into it, the first year, probably not 100% of the money is available to you. But within 30 days of implementing it, you can start borrowing from it. There is only one rule that IRS has around it, which is called the MEG, which is a government limit, that the cash value and the death benefit has to be in proportion. And that we have to meticulously take care of it when we are structuring it. So when I'm structuring, I take care of that. And the proper structure, I cannot insist enough. This is not your ordinary term. This is not your even ordinary whole life product. Even with the mutual companies and the dividend paying, it has to be strategically structured. It can be set up so you can borrow from first 30 days itself to start implementing it, but it also provides you additional benefit. Of course, the death benefit is given. The disability waiver comes with an additional charge. So in case of disability, it continues to have no payment, no premium payment for you if you add that an at cost rider. But it also has a chronic illness rider, most of the times free of cost, and the accelerated death benefit rider free of cost available. The difference between these two is this is for the terminal condition, and this is not your classic long-term care, but it does provide for some nursing care. If this a condition that you have 2 out of 6 daily living activities, if you cannot perform and which is permanent, it can also pay that. So that's the advantage of it. And with that, what's next? It's really the step one is for us to get together, understand what your goal is. A lot of education happens on this call. This is a commitment of few calls together. And I have the free strategy session just to see even if it's the right fit for you or not, right? Once we create and implement that structure, you can max fund, implement this efficiency into infinite banking. You receive your guaranteed dividend or guaranteed dollars or dividend. Most of the times it's a dividend. Now you let it grow without disturbing for years, actually till the day you die. You want to access it for any time, for any reason, you use a leverage and you refund that back and repeat and keep on continuously going through it. So with that, Chris, I can take some questions if you or anybody else has some questions.
Bobby, this was fantastic. And you hit on so many great things. I can remember the time that I learned about this concept a few years ago, and I was away. It was the Thanksgiving holiday, and I was deep into increasing my financial intelligence. I had already taken the gateway drug with reading Rich Dad, Poor Dad. I was deep in podcasts and going nuts on all this stuff. And I came across this and I was like, wow, this is fascinating. I just wanted to learn more. You hit on so many different things from the dual asset strategy, the flexibility in this tool versus others. The financial blueprint I thought was really just brilliant way to illustrate these things. Really the importance of the structure and the help preventing this becoming a MEC or a modified endowment contract are so important for people to think about. With a lot of folks here that will watch this on a recording, especially, or even here live, will think about how can I use this in different ways? Think about college planning with the 529s. It's limited in terms of what you can use it for. But with this policy, it can be flexible. And if your child wants to start their own business, then they have a tool to be able to do that. There's just so many different things. And I learned a couple things. I learned a couple more things too around the FAFSA and the ability to use this for an accreditation, like even for me, for being familiar with this, I was not aware. So just so many great insights. And I know, yeah, I want to make sure that anyone, Jacqueline, if you have a question, if you want to ask it or pop it in the chat, please do. Otherwise, I'll just ask a couple questions too.
Yeah, absolutely. I love everything that you just said, Chris. It's so important to look back at what we have created. And instead of just passing the right tools and techniques, imagine that if you had started when you started building it, if you didn't take that step, right? If I didn't take that when I started doing this, my kids' education, my daughter's education was on the horizon, right? I started building that and I utilized that using leverage for her education. So I don't spend that money for education, but actually it keeps on compounding and growing even after her education is done. So if I hadn't taken that step, if you hadn't taken that step, this growth that it could have done 4 or 5 years, after that 5, 6 years, it's really start having exponential growth. So many people will sit here, think about it that yes, this is something I can do. And if the couple of years pass by, the kids grow, the kids go to their education and want to start utilizing it. If you don't see yourself creating it, you can't utilize it when you want to utilize it in that future.
Absolutely.
I do have a question. The insurance policy, this only applies to whole life policies, correct? Not term life?
No, the term life does not have a cash value to it. And in fact, this is not even the ordinary whole life insurance. So people often come and say that, hey, I have a whole life insurance. Can I utilize it? I often take a look at it and review it. And quite often it's not applied to that as well. And I'll tell you a reason why, right? Like I said, that this is strategically structured. In a regular whole life insurance, 100% of the premium goes towards purchasing you that death benefit. And cash value is just a byproduct of it. But the structure that I create, try to slash that cost of life insurance to almost by 1/3 so that the 2/3 sits there as a cash value from day one. A typical whole life product, even with the same company, same product, if it is not structured right, it cannot give you that high cash value. We want to create that high cash value scenario because that's when the dividend comes in and starts giving you that dividend from year one. So this is not just an ordinary life insurance product. It's a great question. It has to create that cash value.
Okay. And are there specific medical conditions that would exclude you from this?
So as long as your medical conditions are managed, typically you do get qualified for that. But if you have unmanaged blood pressure or if it is unmanaged diabetes, everything that is managed can get you some level of insurance. If you don't get that, somebody else in your family, your spouse or your kids, somebody else can do that because the intention for us to start this compounding and start utilizing it, right? So we can do that on literally anybody's case.
Yo, Mapi, I'm gonna thank you again for this. And before we let you go, everyone that joins this meetup, all of our guest speakers and presenters, they have to get on the hot seat for a few seconds and answer a few questions. And I forgot to mention at the beginning of the meetup that this is actually the start of our fourth season, if you will, of this meetup. So I hope you're ready to be on the hot seat.
Absolutely correct, Chris. But before we go there, if you have 5 minutes, can I just add a little bit more to
Absolutely.
the solution that we have?
Please.
So I'm going to start by asking that why people quite often say that I haven't heard about internet banking. And why is that? Because really the wealthy know it and when they have been using it for generation, nobody really invests the rest, but they end up buying the term and not protecting themselves. And like I said, this is not your ordinary life insurance, not IUL, VUL, or term, or not even a whole life product. One point I do want to say that the institutions who are not telling you to use it, they're actually using it. And this is the going back to it, the history again proves it. Walt Disney has used it. We saw the Rockefeller family used it. Jesse Penny also used it in 1929 crash. Everything else came tumbling down. He had to pay payroll through using this. But what's really key important here is the majority banks, including Bank of America, JP Morgan, Wells Fargo, they use something called BOLI, which is bank-owned life insurance. And the corporates like Walmart and P&G, they use something called COLI, which is corporate-owned life insurance. So if you look at the FDIC call reports, this is public information, by the way, the BOLI, JP Morgan has about 10 billion plus. Now, when is the last time JP Morgan advisor told you that, hey, you should get a life insurance, which is a whole life product, and create this? Bank of America has $8 billion plus. Wells Fargo has $18 billion. Citigroup with $4 billion. And the banks use BOLI because this is actually considered as financial asset, not just an asset, but it is a top tier asset. It strengthens their balance sheet and adds to their capital preservation. Even they this non-interest income, which gets the tax benefit, and it also offsets their employee benefit costs. So this was like mind blowing for me to see that the same institutions never tell you this. They have been secretly using in billions and billions of dollars, and 75% of Fortune 500 companies have also been buying this. So really, that question for me to you is that if it's good enough for banks and large corporations and billionaires, why is it not good enough for you? And I always talk about the timing of it, right? People think that, okay, this is good, this is really helpful, it's very important. If you don't take that action today, if you don't take it tomorrow, the importance is going to go down by 50%, and another day, another 50%. By end of the week, this importance is going to go completely away. The time to take action is not tomorrow, not even today, but the time to take an action is now. So simply one step to jump on a call to see if this is a right fit for you or not is what I will highly encourage for you to take that step, and at least take that baby step to at least start moving towards that future.
No, this is fantastic and a great way for people to make sure that they can scan that QR code or find the bit.ly link, type that in, and schedule a call with you to learn more about this. But yes, I will jump into the questions now so that we can learn a little bit more about you. And this is our fourth year of this meetup, and it's been a journey where we've grown it to over 1,100 people, and it's just been remarkable. And we get people to come and learn and join and just expand their wealth mindset and increase their knowledge, and they get to learn from people like you. So this is phenomenal. One of the things that I think is important is for people to get to know you a little bit more. You shared a tremendous amount about your journey as someone who's come here living the American dream and building yourself up and continuing to make an impact on the community, on the society. I think it's really important to kind of get into travel. I love to travel, and I want to know for you, for someone who's done so much and probably has seen so many things, what is one of the best trips that you've ever taken and why?
Wow, love that. We recently just came from London. So that's fresh on the mind. And I really like London because I don't know if you know about me, but we stayed in London for 1 year. So that is where our journey began, right on the anniversary of our marriage, for the first anniversary. We flew to London and we stayed there for a year. And the reason I really liked, and this was a memorable trip, is because this time the kids were with us. So we visited some of the areas, but we also got to visit the studio apartment. I think it was like 300 square feet apartment with a tiny kitchen, and everything is just around, turn around, and everything was just there. And we lived there for a year. So it was nice to show kids. That's where our journey began. And now we are in a 10x bigger house, and probably my kitchen area is bigger than that studio apartment. So that was a very memorable, not just memorable, but a very humbling trip as well.
For sure. That's wonderful. And to have that experience with the kids is definitely a great thing so that they can see what things were and how far you've come. Amazing.
Yeah. Yeah,
Um,
absolutely.
you talked, so I know you're involved in so many different things, but what are you working on these days that you're really excited about?
Like I said, that my mission is to change the financial trajectory of thousands and thousands of families, right? So I sit back sometimes and I think about that. How can I make that impact? And by the way, my favorite book is Go Giver by Bob Berg. I even had a chance to interview on my podcast Bob Berg himself. So the book pretty much talk about how you can focus on adding value, massive amount of value to massive amount of people, right? So I'm really working on how I can touch this thousands and thousands in life. For me, I'm right now building a program where what I know with the infinite banking or commercial real estate, how I can help different communities, different people. And your community is one of the example of it, infinite banking with joining hands with the people like you who are passionate, equally passionate about not just the education, but bringing this out of the box, high value opportunities and high value strategies to their investors. So I'm building on working on that. And really, when I talk about, people quite often come to me and say that, what is your next investment coming in? What is the IRR? And I'm like, I ask them to wait, hold on your horses. I want them to, when I say that, look at beyond that financial freedom to grow, preserve, protect, and pass their generational wealth. It's a holistic wealth, right? So the wealth in the want is the strategy, the kind of a holistic perspective that I have built for my passive investors or even anybody that's touching that life, right? So, really going back to that Maslow's pyramid, people think that, yes, I want to implement it, I have to implement it. But how many people have done the estate planning? How many people have done the tax planning, not the tax filing, right? So, that is what I'm very passionate about, and that's what I'm working on. That how I can give this as a one structure to people and how I can implement and help implement with this massive amount of touch points with partnering with people who don't even know about this.
Fantastic. Yeah, it's important. And I hope that you are massively successful with impacting the thousands and thousands of people's lives that you want to do with the tools and resources and solutions that you have for them. I know that being here and sharing your message and hopefully getting it out to the audience that I have is something that's really important. I want to hit on
Thank you,
one more
Chris. And
thing.
I do want to commend you. You are part of this mission as well. And so thank you for inviting me here. But what I really like about you is how equally passionate you are. And that's probably what brings us together, and your education, what you're building here. And you are also driven by getting those high quality investments to your investors. I don't know that people know this enough, that how lucky it is to find somebody like you who are helping, instead of reinventing that wheel, who you are helping them to get this really vetted investments. And I have seen you, Chris, behind the scene as well, how diligent you are in looking at these investments for your investors. So it's really great what you are also doing with this meetup. So I had to say that.
Thank you so much. I really appreciate that. I really do. It means a lot. Last two questions. One is, you mentioned financial freedom. What does financial freedom mean to you?
Financial freedom means different things to different people. I don't think my mind can not do anything and be financially free and stop working. Because like I said, that as you start growing and your subject matter expertise keep on increasing, what my subject matter expertise in this area, and if I don't serve you, if I don't add that value and don't teach people forward, it's a misuse of all that knowledge. So I think education is my passion. So I see myself doing this, helping people understand financial terms with simplicity. Simplicity is my superpowers. I do a lot of education. So I do see inspiring people and helping people to be me. If somebody wants to do what I am doing, I would be happy even now to take them on that journey. So I think financial freedom for me, it means helping people who are starting their journey, inspiring them, speaking at different stages and different places. So when I have, and like I said, I have the chronic health issues that I had to quit my corporate job. I still have that. With that inspiration, if I can do it, and so can you, if I can inspire even just one person and change that person's life, I think it's totally worth it. So that's what financial freedom means to me, is to keep on inspiring.
I have one more question for you that I love to ask folks, because you talked about financial freedom. The name of this meetup is called Wealth Mindset. You emulate and you lose wealth mindset. But tell me, what does having a wealth mindset mean to you?
I think having a wealth mindset is for me that think outside the stocks. It's not just the outside the stocks. It's my perspective of outside the box. It's always outside the box for me, whether it comes to my kids, whether it comes to my family, whether it comes to the strategy that I picked. It's about changing mindset and being open to it. Infinite banking was something new that I have not heard about. Syndication was something new that I had not heard about. Everybody was doing maxing out their 401ks. There is a herd mentality that everybody just flows through and does one thing, putting everything in the stock market in 401k without even realizing what that stock market is and how it performs. Nobody had, when they started putting 401k in the stock market, had the knowledge enough to play with the stock market. So my question is, what is the mindset that you have? Mindset, this is the real estate that's between your ears. That's the biggest real estate that you will ever have. And you have it right now too. So if you don't change your mindset, if you don't challenge what is defined as norm, there is a ceiling that you're going to hit. If your ceiling becomes your floor and you want to grow exponentially from that, the mindset is the only thing that's going to change you. When I say that think outside the stocks, is I'm not against stocks. It's about diversification, but it's not even just about stocks or outside of the stocks. It's the outside the box mentality. But in fact, I'm going to challenge you, Chris, that why even have a box? What if we just think outside? There is no box required.
Perfect. Perfect. I love it. And I love that paradigm shift to help people change their thinking and really unlock some things. This was amazing, Mavi. I really appreciate it. I want to thank you again for taking the time out to educate me, my audience, the people, the live attendees, and the folks that will watch us on the recording here and learn something. And I know that you put your QR code earlier, but maybe if you just want to just quickly shout out how people can get in contact with you, and then we can have that for the recording as well. And look forward to people reaching out to learning more.
Absolutely. Thank you so much again for having me. This was an incredible conversation. Thanks for all your questions, and the audience had great questions too. Thanks for being a part of this mission. And with that, think outside the stocks. That's my podcast. That's my website as well as all the handles on social media. But if you do want to get that strategic on, just start your journey somewhere. bit.ly /infinite underscore call, all lowercase. That's how you can get to my calendar and get on that call. But there's a ton of resources. Even with Infinite Banking, there's a lot of educational resources on the website. You can have a master class in Infinite Banking, understand it a little bit more. So that's how you can get in touch with me. Again, thank you so much for listening in. And thanks, Chris, for having me as well.
Well, thanks. Thank you, everyone, for joining, and we'll see you again next time. Take care.
Thank
Bye-bye.
you.